Hello, everybody. Hi, I'm Paula Getz, and I'm one of the co-founders of New Mexico New. I wanted to introduce just a little bit about who we are, New Mexico New, and then we'll get started. So in January 2021, we created New Mexico New. New stands for New Elder World. We are a social profit on a mission to create an ecosystem for an age-friendly world, where those of us age 50 plus remain engaged and encouraged to share our wisdom, our expertise, and our life experience with our communities. We call this group New Elders. We plan to provide 3 pathways of engagement for people age 50 to 70 plus to help us remain active. The first pathway is learning events, like the one we're on right now. In the future, we plan to create 2 more pathways. One is a way for us to find part-time jobs and volunteer at a nonprofit. The other one is a way to connect socially with each other. The date of when these are available will depend on the funding we can raise to build them, so stay tuned about that. So let's get started with today's event. I wanted to bring to light that if you need technical help during the workshop today, look in the chat and you will see Coach Zoe. Coach Zoe, there you go. She has teen years in the background. You can see her. And just chat, put your message in the chat and she will see you. Or if you know how to specifically chat directly to Zoe, pick her in the list and she will do what she can to help you. I wanted to let you know, if you don't know and you're in New Mexico, about teen years, and that we have their website right there and their phone number. Teen Years is an organization that has tech-savvy teens and young adults who help seniors learn technology through one-on-one personal coaching. I think it's the best win-win I've ever seen, because seniors, lots of time, we need help with technology. Young adults and teenagers, they know that technology and they need jobs. And so it's a great organization and we're so happy to have them here partnering with us. So thanks for joining us today, Coach Zoe.
Thank you so much for having me. Thank you.
Yes. All right, so again, we are privileged to get time and have Professor Reilly White here with us today to share his wisdom. I want to just do a little bit of introduction. Dr. White is an associate professor of finance at UNM, the University of New Mexico, at the Anderson School of Management, and he was just appointed assistant dean of teaching and learning there. So congratulations. That's hot off the press today. Along with his students, he recently developed and published in several languages an ebook titled Financial Literacy for Refugees. He also serves as faculty advisor and director of the $3.5 million student-run Regents portfolio at UNM. I think that's what qualifies him even more to talk to us today. Dr. White graduated from the University of Massachusetts, Dartmouth, and earned his PhD from the University of Connecticut. Many of you may recognize him as he's a local TV and newspaper star. He frequently gets interviewed by several of the media outlets. He and his family live in Santa Fe, and we're very pleased that he agreed to design this series of financial wellness for us, specifically for New Mexico New and our growing community of New Elders. So with that, I will turn it over to Dr. White. Thank you, Reilly, for being with us once again.
Oh my gosh, thank you so much. And I want to say what an absolute privilege it is to work with New Mexico New, to work with Paula, Tammy, Ellen, and our fantastic teen years today, and all of you here as well. It is one of my favorite groups of people are our active retirees in New Mexico. They are active, you have expertise, you have built a lifetime of knowledge and experience that you will put to action and continue doing so. And one of the things that we like to address, and one of the things I want to address today, is some questions around financial security, particularly with regard to investments. We talked about different retirement plans, other things last week, 2 weeks ago. We'll talk about building that business, maybe a second career in next week's presentation. Today is all about those things which a lot of us are still intimidated about because of the uncertainty that exists within them. And it doesn't matter what even if you've been in finance your whole life, you will still be surprised by what financial markets have to say. So what I'm going to do today is I have kind of a presentation that I've planned. There is a chat window here. I want you to feel free to ask any and all questions that you would like. Never hesitate. I'm so glad to see. I have a couple of common names that we had there in our audience that were there last week, a couple of new names. Whatever your background, whatever your experience, there's no such thing as a dumb question. Don't be worried about it. If you send it to me in the chat window, you can also find my name and you can send me it as a private message if you're worried about anyone else seeing it as well. You can find me, send me that whatever question you might have, and I'll answer it anonymously in the window. Feel comfortable, feel at ease, and ask questions. So I'm really, really excited to be here. So anyway, so let's do this. So I'm going to share my screen here. Oops. May I have screen sharing permission from our hosts? I forgot to check. There it is. I have it.
There you go.
All right. And so now I'm gonna start it up here. And I know we had a few questions. One of the things I've found, either because of the monitor that I use or because of because of my particular computer setup, I'm going to leave this in a non-presentation mode. So you'll see all those slides on the left-hand corner that are coming up. That's what's coming up. Don't worry about them. This makes it a little bit more visible if I do it this way than if I did it the other way. And I know a lot of you have small screens and I don't want to stress out your eyes any more than they have to. So we call this Investing 101. What should a retirement portfolio look like for an active retiree? And oh, goodness gracious, this is good. In this section, we are midway through our 3-part series. This is about retirement portfolios and investments. Next week, we're going to talk about financial considerations in a business, particularly adapted to whatever idea that you have next week, be it from developing or continuing consulting work you might have already continued, building up a small business. Maybe you have expertise in a shop. Maybe you're selling something, as well as other types of businesses. So we're going to go over some of that stuff as well. So what we have. So the first things are, we have rules of the finance road that go for people of any age, but are particularly relevant for people as they approach retirement. Number 1, don't spend more than you have. And we keep asking ourselves this is Reilly, this is common sense. Of course I won't spend more than I have. We all are tempted by spending more than we have. And the difference is when you are on a reduced income, when you are in a situation where you aren't earning from your career as much as you were previously, it is more difficult to do this. Number 2, don't spend more than you have to. And this is a really, really important one. There is and we all kind of fall into this category. When we sit on this, we look at this, maybe you've invested in a 401k plan, maybe you've invested in something else, maybe you're looking for just that Social Security payment, maybe you have a pension. But if you're sitting on a balance of when you're 65, 67 years old, of a large balance in your 401k, it's very tempting to say, I can purchase this. It's okay. I can make this thing. I won't get multiple quotes for that development or that new project I have with my house. I'm going to involve this. Use all those skills that you've developed in your lifetime and continue them. Save more than you think you need to. You can never, ever save too much. That is not, and this was wisdom told to me. Before I was an academic, I was a banker, and I dealt with all manner of things. And I dealt with people asking for large sums of money to build hotels. I had people on the other side of the equation who were approaching bankruptcy. Save more than you think you need to is a financial cushion, and it's a cushion that gives you power, the power to choose what you're going to do in the next year, the power to have choice, and the power to make financial decisions over the next few years. and always invest in your future. And this is really tricky, right? So I've known people who have a very almost nihilistic fact about retirement. Maybe they've outlived their parents already. Maybe they're the first generation who's seen retirement in their recent ages, and they think, my goodness, every year I have is great, right? But I want you to always plan, and this is a very important distinction about when we talk about portfolios coming up. Plan on living longer than you think you even might live. And I'm not asking you to put that out and be prideful and be like, oh, I worked out and did these things. We never know. No one really knows what their life expectancy is. But this is really important. If you plan on living to 90, always plan on living to 90, plan on living to 100. And what does that mean for finance? It means making sure you don't run out of money when you're 75, 80. The universe has a way of surprising us all the time. And so when these things happen, just be aware, look towards the horizon still. Always look towards those next few years. And I'm going to make this distinction because this is really important, because the thinking in finance has changed a bit regarding retirees over the last several decades. Not only because people are living longer, people are spending greater amounts of time in retirement. And when we look at the mixture of things that people can put money in, one of the things that becomes important is if you're retiring in your 60s and you might have 20, 30 years left, your retirement portfolio might even might have a different risk return profile. I'll tell you what that means next, than somebody who might be than somebody from 20 or 30 years ago, when the answer was, we'll just put it all into bonds and fixed income and call it a day. So I'll go over what this means precisely and how we kind of evolved with time. So I'm using a lot of financial lingo here, a lot of financial terms. And my guess is, we took a survey beforehand. Many of you have what we call a portfolio or aware of having a portfolio already, and that's okay. My hope is I'm going to give you some context looking forward that will be like that advanced level stuff that you're looking for. As well, I know some of you are in the position going, wait a second, I don't have a portfolio. I don't know what any of this is. I'm not certain what any of these terms actually mean, and I need help with this. So we're going to go through each of these things. I'll provide context, and I encourage everyone to add those questions down below in the chat window. So what is a portfolio? So a portfolio is a very interesting thing. And my guess is many of you who think you don't have a portfolio might actually have one. So for instance, if you have a 401k plan, or you have an IRA that you've invested in as part of your retirement plans, the plans we talked about 2 weeks ago, you've given money, a portion of your salary, to be taken by whatever corporation or whatever firm you worked for. They hire a money manager who manages that money in a 401k plan. That 401k plan, where your money goes, and you get a statement and you get some information about the nature of that plan is invested in other things. The money that you take out of your salary that your employers matched are invested in all things. Companies in the form of stocks, companies in the form of bonds, a type of debt that we'll get into, as well as other things, mutual funds, ETFs, exchange traded funds. We'll go over all those definitions, so don't worry about any of those things. But you have, in this sense, a portfolio. Also, in its simplest form, if you have cash on you and you've only ever bought cash, you too have a portfolio. So if all that you own is in your wallet right now, if I open mine, let's see what flies out. I got moths and I don't know, but I have a few things. If you have just cash in your wallet, that is called a portfolio. It's a portfolio of 100% cash. And so really the difference between this is the language that we use. You've already been doing it your whole life. You have some money in savings. You have some money in investments like your home, which has equity within it. That's part of your portfolio. You have cash on hand. That is also part of your portfolio. So your portfolio is all the money that you have out there in any various places. And let's talk about what this means and what we can do with it. So first of all, there's one thing about portfolios that becomes really important, and you're going to hear it all the time. Good portfolios are diversified. There are many different kinds of things. So instead of just cash, they might have property, real estate, stocks, bonds. You can invest in funds that manage all manner of things. You can invest in funds that invest in art. You can invest in funds that invest in real estate or real estate investment trusts. You can invest in all sorts of different concepts. And And all of that can be part of your portfolio. Diversification is owning, in its simplest form, is owning more than one thing. It's owning a few different things. And I'll give you an example of what this means. For example, let's say you worked for Microsoft your whole life, and you only owned Microsoft stock. When your value goes up and down, and I'm doing this intentionally because I know Paula was an Oracle person, but one of those things, and you only owned Microsoft stock for a very long period of time, you are exposed 100% to Microsoft. So if Microsoft goes bankrupt, you lose everything. If Microsoft changes CEOs, your value of your portfolio changes. You're exposed to what we call firm-specific risk. This is called diversifiable risk. Now, when we start adding other companies to the portfolio, Microsoft becomes less important. We add something like Mattel. We add Exxon. We might add Array Solar, a New Mexico-based publicly traded company. We might use a few other companies in there, and suddenly individual movements of individual stocks become less important. As we increase the number of stocks in our portfolio, we diversify our risk. And then what we have at the end of the day is, do we have no risk? We always have risk, but the risk is called market level risk. It's non-diversifiable risk. And we can reach that with only 12 to 20 stocks that are from different asset classes. So there's a lot of information here, but as you note, stocks are one portion of this. We have bonds, cash, and property. The more sources of places to invest your money, the safer you become in things like downturns and other things that we have to worry about. Now, risk and return become the fundamental underpinnings of how finance works. They're always related. The higher the risk, we often say the higher potential return. However, being that risk and return are related, we know that's not always true. You can invest in a risky investment that fails. You could lose all of that money. You can invest in a risky investment that becomes a game changer across the globe. And this would bring you a huge financial dividend. And the thing that we know about risk, in the same way you look at this, as you might view your own family members who might be younger and other things, is how risk tolerance changes with age. The things we are willing to do and take on when we're 18, 20, 25, or 30 are vastly different than what we're willing to do at 55, 60, and 65. And I know we're going to have, I know about my bet is a couple of people who will be attending next week's session about building a business, or they're like, I'm ready for risk and I'm ready for this. So not all the time. The key is to know yourself, know the journey that you've been on. And for many of us, risk tolerance goes down as we get older because we have more responsibilities. It becomes less about acquisition and about preserving what we have. And so when we think about these things, about how this changes with time, and I have 4 traditional portfolios that are documented at the right. When you're a young investor, and this is traditional, and I'm going to say that it's traditional, this is not explicit advice. That depends on you and your financial advisor. I also want to point out that these values, while they represent historic values, might not be the right fit for you as an individual. When you go approach a financial advisor, one of the first questions they ask you, they might give you a series of questions, a series of tests, and kind of like a little quiz to try to figure out what your risk tolerance is. You might have exceptionally high risk tolerance. Go with what you're comfortable with as an individual. Don't feel pressured to fall in line with what everyone else does. But know that everything we do has consequences in certain aspects. Younger investors have a long time to make money. So their portfolio is going to be mostly stocks, mostly risky items, maybe private equity, other things. And the reason is that when they confront something like, say, the 2008 financial crisis, they can overcome that with another 10, 20, 30 years of work. Now, when I was a banker in 2008, which was probably the worst year to be a banker. But one of the things that I worked with a brilliant financial professional, and one of my mentors was this very nice man named Fred. And we didn't see eye to eye about all things because I was young and impertinent, and he was wise in many ways. But he was looking at retiring in 2008. He was heavily exposed to the portfolio. His portfolio, his personal retirement portfolio, was heavily exposed to stocks because that generated a lot of money for him in the 2000s as well as it did in the 90s. So when the 2008 financial crisis struck, he ended up losing a lot of money. He had to delay his retirement. He would have been 65 in 2008. I flew back to Boston, where I was a banker in 2016, and I visited for my other boss's retirement party. And 8 years later, he was just retiring at the age of 73. Now, because it took that long to recover from the losses that he had in that retirement principle. When you're young, you can afford to lose. When you're old, it's less so. And the last thing I want anybody in this discussion to have is to feel like they have to work longer than they should to make sure their portfolio is okay. So be careful at this. And we say about these things in finance, buy low, sell high. If something looks expensive, don't buy it. Now, low risk savings options. You guys know a little bit about this, all right. This is a great question. I want to take an aside question. I have a private question, which is really excellent. What kind of financial advisor will meet with someone that is starting from scratch and does not have a large amount of money to be invested, but needs to build from bottom up? And I'll tell you that they do exist, and I'll give you a few examples of this. And so, yes, we do have a lot of financial advisors in town, particularly if you call them up, you found them on the internet, and they ask how much money you're looking to invest. And if you don't say something like $5 million or $3 million, they put down the phone and they go, some very specialized practices focused on high net worth individuals. But I want to point out a couple of things. So the first is, this is a great discussion because I want to make these points as well. In the financial industry, there are a lot of movers and players that will invest at any level. They have without advising anybody in particularly, look on their website. If they say we're inclusive to all people of all wealth levels, they're good. Now, large companies, Charles Schwab, Fidelity, large companies you associate with diversified financial systems, always provide advisement services, but there is a catch with that. The first is the tendency over the last 20 years is to do something called robo-advising. In other words, because the margins or the amount of money that people make from wealth management for people who don't have a lot of money is very small, they tend to push people towards an algorithm. So a large company, and actually there's only about 2 or 3 big algorithms that populate a large number of these different wealth managers out there. So what happens is you go to their website, they ask you a bunch of questions about your risk tolerance, how much money you have, and then they kind of calculate in using the computational algorithms, what portfolios, what you should do, how you should invest going forward. And it's mainly an automated process, but they do have people in support to back up, to ask that you can follow with questions. But that's how the industry has sort of moved in the last 15 or 20 years. Now, that said, the first thing about an advisor is that they should be able to give you the time of day. You should be able to call them up and they should be able to talk to you. And when you want to talk to somebody and consult to someone, that is an incredibly reasonable request. And they will provide that service for you. So I want to point out, so the first thing is smaller firms that focus on high net worth individuals might not give you that service. Larger firms will, other companies will, but it might be a robo advisor, so to speak, an automated system. There are advisors who operate in the middle who do a lot of other things. They are out there, they're worth it. When in doubt, a good place to start, and I would say start, would be with one of those larger shops, because you should be able, before you commit anything to anyone, be sure you evaluate multiple people to see if you're getting the service that you want. That's a really good question. And so I don't want anyone who's intimidated about just starting out in this. We're going to have a little portfolio sheet to go over this more. Savings and money market accounts are what a lot of people are familiar with in this. And I'll give you an example. I would argue that savings and money market accounts are really, really useful. For instance, you might have something like a CD, a certificate of deposit, where you deposit your money and you get a very small interest rate for a very long period of time. I knew someone very well who was given really bad financial advice when they were in their late 40s. And they were told to put all the money that they had into CDs. Now, CDs, this is a very interesting, I don't know the nature of this. They told me this story and I was so astonished that somebody made this recommendation, but it happens all the time. When you did that, and this person retired about 5 years ago, at the age of about 65. So let's see. So if I'm doing the math here, that was 2016. So they had invested in the 90s in CDs. And CDs, this was a time, the last 25 years, interest rates have been pretty low. And except for a few times where you might have gotten more than 1%, those interest rates have been really low. So that person had, at the end of the day, only a little bit more money than they contributed. They should have taken more risk. If they invested in almost any other asset class, they would have done better than they did. And so know that these exist, but we have a tendency to be more conservative than we ought to be, especially in retirement. But that being said, be careful with your funds. Now, when we think about stocks, this becomes where people start losing it. When they think, losing their confidence level, inability to handle finance. When we're thinking about things like savings options, that makes sense. We walk into a bank, we have a relationship with a banker, they provide us a direct piece of knowledge about where our money is going and what happens afterwards. Stocks seem weird, and it seems like a strange thing because it seems more difficult. So stocks have a very long history, and I'll kind of go into this a little bit briefly. We can go back to the year 1286 in Sweden, where a mining company called Stora issued 8 different shares to individuals. Partial ownership to companies has an 800-year history. Now, stocks themselves in the modern sense belong with the age of colonialism, age of exploration. In the 1500s and 1600s, we sent merchants would send ships across the world for spices and other valuables. Very few ships would return. No individual wanted to take on, very few individuals wanted to take on all of that risk. So what they did is they split it up into individual shares. These became the first concept of a corporate share. I won't buy a full ship that could sink in a storm, but I'll buy 1/100th of a ship because I know that I'll only lose a little bit of money if that sinks in a storm. And then Amsterdam, the Dutch East India Company, set up what was the first stock market in the modern sense in 1602. So if you've been to Amsterdam, you can visit that location. Many years ago, I visited that when I got married to my wife. She was like, "Why are we here?" And then I had to go over this vast, elaborate system of financial history. And then she fell asleep. But one thing was, she was the most patient person alive. Stocks are delightful because they offer a share in something that is real. And it means you're an owner of that company. You get to vote on the board of directors. The directors hire the management, and the management helps boost the stock price. We call stock ownership equity in finance. And again, there are 2 ways that we can earn money in stocks. The first is the appreciation of the stock price itself. The company becomes more valuable going forward. And when we look at valuing companies, the big question that we have, the big thing that we need is not where the company was, but where the company will be. And so when you make things like investments in stocks and things, focus on, is that company going to be bigger, better, and more awesome in 5 years than it is today? And you also get money through dividends, and dividends are the annual or quarterly or annual payments to shareholders. These dividend payments give you a stream of cash. And when you're thinking about this in the context of every place you get your money, those dividend payments you pay capital gains taxes on, which for some people might be lower taxes than they would otherwise pay. So Microsoft Securities have very different things. They have all of these different symbols and things. There's a big differentiation I want to make. The first is that we have 2 big exchanges in the United States that trade stocks. So stocks are useful because not only do you own a partial share of something, but you can quickly trade it to someone else. And the 2 big exchanges are the New York Stock Exchange, where everyone you see somebody with a gavel, they hit a bell, things happen, it looks just, it's madness. People are walking around and running around. And then you have NASDAQ, an exchange that's heavy on technology companies. NASDAQ operates like almost the rest of the world does with regard to stock exchanges. All of those calculations are performed automatically via computers. Like visiting, say, the European Stock Exchange in Frankfurt, you visit it and it's a machine of computers running and making calculations, as opposed to sort of the madness that we see in New York. But all of these things meet, and brokers connect buyers to sellers. Brokerage houses are everywhere. Brokerage fees for connecting buyers to sellers have come down drastically in the last 20 years. Now many places offer free trading on stocks. Some things to note about a stock, if you look it up, one resource that I find particularly useful is Yahoo Finance. And Yahoo Finance, finance.yahoo.com, I like because it's free, which is the right answer for most things. Never spend more than you have to. Finance rule number 2, or finance rule number 3 in our last situation. But if we go to some place like Yahoo Finance, it comes up with a lot of data, a lot of intimidating things. But some things to note, some features about a stock price. People talk about how big a company is. That's called market capitalization. If you boil down to what a stock price is, it's the value today of all the future earnings the company will make between now and the end of time, divided by the number of people who own the stock. That's the formula behind it. And so if a stock price goes up and down a lot, investors are changing their future projections to how way they think that stock will do. A company like Apple, which is worth more than $2 trillion, that's called a market capitalization. The number of shares in Apple that are out there multiplied by the price of Apple gets you to market capitalization. $2 trillion. To give you a sense of how much money that is, if we valued all the economic activity in New Mexico, we would have $100 billion per year as our GDP. This is more than 20 times that for a company like Apple, Microsoft, Google, other companies that are very, very large in that category. Stocks have different risk. And what happens is when people, millions of people, are trading on this stock to give it a fair price. And stocks that are traded on major exchanges are mostly liquid, meaning that there's enough people that are trading them back and forth that whatever the fair price should be at any given time should be reflected immediately in the stock price. And maybe, let me see if I can grab this really quick here. Maybe I can do a little example here. So when we have bad news about a company or investors are bearish about it, the stock price typically goes down. And when there's good news about a company, the stock price can go up. So let me grab something quickly. We'll do a little live finance here for you. And I'm going to share the other screen in 1 second once I get this website up and running so you can take a look at it. And I'll do a little example here for you. Let's see here. Let's see. I'm going to load it up first. Let's think. Let me click a good company here. One of the larger companies in the United States. So the reason we're going over this in a little bit more detail, let me grab this really quickly. Let me share the screen, is one of the reasons that we're going over this in a little bit more detail is because I want you to feel comfortable talking to financial advisors and other people about something that few people, unless they study finance, have the opportunity to learn. And I always want you to know more about everything possible. But if you go to a website like Yahoo Finance, look up an individual company, you'll get something like this. It'll show you over the period of time how the stock price has gone up and how the stock price has gone down. And when we consider this in the context of the overall picture, we get a sense for how the company moves. Now, there's a lot of other data here. We don't have time to get into all of this, but I want you to be aware of all the useful stuff that's out there and to ask questions. And I want you to always feel free to ask me anything possible. But you can go up, you can look for any company, you can go and look for a company like Microsoft or Facebook or Google and see how their stock price is doing. And what this is an example of a bunch of people making guesses. Making estimates to what the future earnings of a company will be. And I think the best company that we haven't clicked is Oracle. So let's click this. This is really good. Look at that stock price. Oh no, one of those Paula is trolling me now. But one of the things that we have here over time in the last 5 years, what happened is people, will invest in Oracle. Oracle has good news about their earnings. People raise their expectation of earnings and the stock price goes up. Then different news happens, the stock price goes down. And some of this can be Oracle specific and some of this can be market specific. What's happened in the last year with a lot of major stocks is we have really, really low interest rates. People need to find places to put money that generates a return. So people put it in the stock market. So when interest rates are really low, that incentivizes people to put more risk in the stock market, more money in the stock market. Stock prices become really, really high. And so that's something to be careful of. And if the Fed came out tomorrow or in 2023, like they say they might, or somewhere in between those times and said, we're going to increase interest rates, then we know that that will have a negative effect on stock prices. This is really good. I want to make sure that it's important. We should always cover Oracle. Now, going down a little bit about this on stocks, we know they're risky. And if you really want to impress your kids, nieces, nephews, relatives at the next family reunion, tell them I showed you a probability density distribution, and then sit by the fireplace and stare into it. And that will give them, you'll have this newfound respect from all of your relatives when you describe these things. Stock markets are risky. Charts are just obnoxious, but I have to show this to you. People say the market is gambling. You walk into a casino, right? You walk into Isleta, or you walk into one of those casinos around New Mexico. And you know, because of the math that goes into each of those machines, a slot machine, a roulette table, that the house is going to win. The house, the odds, the statistical odds in things that don't involve skill are geared towards the house winning. And so people say, the stock market's just gambling. The stock market is very volatile, but in the long run, you win. That's the long run. You're the house here. You will go in, and if I put all my money in a casino, I know that if I played it long enough, whatever individual slot machine is, even if the ratios are very small, I will lose more often than I will win. In the market, the opposite is true. There are years where you will lose lots of money. There are years where you will gain lots of money. The average return in the period between 1990 and 2015 is actually almost identical. Note that that includes two recessionary periods, the tech bubble crash of 2000 and then the 2008 financial crisis. In that period of time, the average return was about 11%, 10 to 11% per year. That is what the market gives over the long run. The hard part is, it's going to be, nobody can predict what the market will do in a year, nonetheless what it will do 5, 10 years, 15 years out. And it is humbling, but it is real to say that there is nothing to keep the market from having a 10-year period where it disappoints us, or a 10-year period of low returns, or not a lot of money going into it. But that said, in the long run, historically, in the 100 years of observations we have, you will win. The other tricky part about this, high risk doesn't always mean high returns. And we think about this, we call this a probability density because it shows you the odds of something happening. We know most of the time market returns will be around 10% per year. Sometimes they might be 50%, sometimes they might be minus 50%. Individual stocks kind of work the same way. There is a distribution to their returns. And you might argue and say, well, Reilly, if risk is related to return, does that mean if I take on a huge amount of risk with a stock, I will certainly have a high return in the long run? And the answer to that is unequivocally no. Coca-Cola, let's see some examples of this. This is hard to read, and do not try, but I will read it. Coca-Cola in 1970, if you put $1 in Coca-Cola in 1970, and I'm bringing this up to 2007, right before the financial crisis for a good reason. But if you start in 1970 with $1 in Coca-Cola, you would have had almost $100 in 2007 over a 37-year period. That's a pretty good rate of return, even when you factor in inflation. Pepsi, start with $1 in 1970, $200 in 2007. That's a pretty good rate of return. Look at the size of that distribution. Sony, even riskier than both Coca-Cola and Pepsi, a wider distribution, like a wider hat means a riskier stock. But it had a lower average return. By 2007, you'd only have $64, not 100 or 200 like Coke and Pepsi. And my favorite one of all is United Airlines. You invest $1 in United Airlines in 1970, you would have $0 in 2007 because they were undergoing bankruptcy. They were in bankruptcy at that time. And when a company goes bankrupt, they often get rid of all of their equity shares that are outstanding and have to issue new ones. And so all their old stockholders are left holding the bag with $0. And that happened with General Motors as well. We know General Motors is still around, but during the 2008 financial crisis, they were doing so badly that they went into bankruptcy protection. All the old shares were worth nothing. And so if you hold GM shares since that time, they've since gone back to the market and issued new shares. Also, a quick note about this. You may have remembered a time when we used to have stock certificates, actual paper representations of stocks. What's happened then, in addition, there was all this stuff that happened in the 1960s. We had the Wall Street paperwork crisis. It became very unwieldy to physically take large amounts of stock certificates and transport them and move them when stock was exchanged, and also very expensive. And so they digitized that, and we actually have something. We have something called the DTCC in the United States, which is a centralized clearinghouse for deposits and stocks and equities. And what happens behind the scenes when you buy a share of stock from a company that matches buyers and sellers, called a broker. A broker could be anybody from a large company like Fidelity to a smaller company. There's all these terms. Robinhood is an app, that's a broker. And a broker connects buyers and sellers to stocks. It is clear behind the scenes with the DTCC. And that's one of the biggest and most interesting financial agencies that not a lot of people know about. And many trillions of dollars take place every day with that company, with that institution. So stocks are one thing. Stocks are risky. And when you think about when your portfolio is invested in stocks, that's what that means. You have ownership shares in a bunch of different companies. Some companies will do well, some companies will do poorly. But in the long run, you typically do well. The question is your time horizon and how much risk you're willing to take. Now, historically, one of the things is, as you approach retirement, the question was always about bonds. Now, bonds are things people talk about. We think we know about them. I went through an undergraduate education. It took me until I was actually in banking to figure out all the details I needed to know about bonds that ended up being this way. It is a confusing thing. And I am not going to destroy this with too much lingo on you all, but I want you to know a few big things about them. In a bond, you become like a bank. A company like Oracle wants to build something, a new factory, perhaps a new fabrication plant, something else, maybe a new place where they can, a new building where they can house some of their outstanding system software people. But they build something big and they have to raise money for it. And so what they'll do is they'll go to we call it a bond maker or a bond institute. It could be something like a bank. Usually it's an RBC Capital Markets. There's 30,000 different entities that can handle bonds across the country. And they go to one of these entities and they say, I'd like to raise money in the debt markets. And so one of these investment banks does a calculation. They say, okay, you have this type of financial performance, you want to raise this for your project, and they'll be, okay, we approve you for $10 billion of a bond issuance. And then they find people to buy the bond. And who buys the bond? You, me, investment firms. Usually they're packaged as deals. Usually we're not on those bond issue calls, but we'll own bonds. But they're usually firms, investments, mutual funds, all over the place, they buy bonds. And these bonds, you're buying debt instruments from a corporation. You become a banker. And so like a banker, you receive interest for holding or giving money out in the form of debt. So let's say I like Oracle and I give them $1,000 to buy one of their 10-year bonds. 10 years is called the maturity. It's a 10-year debt window. And so Oracle goes, great, Reilly, thank you so much. In return, we're going to give you a payment every year called a coupon payment. And this coupon payment is based on how risky the company is. For large, safe companies like Microsoft, Google, Oracle, they pay really, really low interest rates, about 2 or 3 or 4%. So let's say 3% is what the interest rate would be. If I gave them $1,000, I would in turn receive $30 a year for 10 years. That $30 a year, 3% of 10,000, would be income that I would recognize as under capital gains taxes. So I would receive that and I'd pay the capital gains tax on that income. So if you had a lot of money, $10 million, $100 million, you can invest in very safe companies and live off of that stream of income, which a lot of people do. So if I had $1 million, you're like, $30 isn't a lot, Reilly, but if you had $10 million, 3% of 10 million is $300,000. We could all figure out a way to live off of only $300,000 a year, couldn't we? And so when we think about people who wish to hold on to large amounts of wealth, investing in a fund or companies that provide a stream of income become an easy way of doing it. Bonds are also, generally speaking, considered safer investments because when we think about that distribution of returns, bonds are much more focused. They do go up and down in value as interest rates change, and this is very important. As interest rates go down, bonds paying higher interest rates go up in value. And like other things, there are two ways we can make money on a bond. We can make money as the price of the bond fluctuates and goes up and down. Even though I may have paid $1,000 for this bond at Oracle, if interest rates go down, more people will desire my bond and the bond price might go up to $1,100 or $1,200. Likewise, if interest rates go up, interest rates are right now very, very low. Hint, 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 hint. So if interest rates go up, what that does is existing bonds that offer very low interest rates become less valuable and their prices start going down. And the maturity date is basically the date that they have to repay it. And a lot of corporations work like this, and the government as well. The government has bonds, 10-year bonds for a corporation, often because they're paying interest-only payments to those bondholders, that little stream of income that you, I, and all those other funds receive. They'll usually refinance that bond, or inside of themselves, they might have something called a sinking fund where they put money aside each year to pay off those bonds when they come due. So bonds can be very fun, a good way to have stable income over a long time and kind of evaluate it. Bond risk is really tricky, and I want you to pay attention to bond risk. The first thing that we value bonds is there's three big companies, Moody's, S&P, and Fitch, that use bond ratings, and they have little formulas. Each of them have slightly different formulas that are very similar about almost like a credit score for a company. That say if the company is creditworthy or not creditworthy. So for instance, and this is a really good question on this. Ooh, another private question from the audience. If interest rates go up, should we sell our bonds? This is a really good question. I want to point out something interesting about markets and market timing, because this is a really good question. When interest rates are really, really low, and if you bought a lot of bonds this year, and interest rates are really, really low, historically low, like we know that they were lower than they were 10 years ago and 20 years ago and 30 years ago. It's possible that interest rates can continue to go down. But if we're trying to bet on where interest rates will be in 5 or 10 years, it'll either be close to where we are now or above where we are now. And that means that the bonds that we bought this year at low interest rates will decline in value if interest rates go up. But that being said, it doesn't mean necessarily that you should sell them, and I'll point out why. So when bonds prices go up and down because they're forward-looking, investors, PhDs, MBAs, thousands of people are observing the bond markets each day and making guesses as to what they think the price will move up and down. So before even the Federal Reserve makes a decision, a lot of that will already be factored into your bond price. So if we're talking about a 5 or 10-year bond, not only is the bond pricing in the conditions of right now, but it's already priced in the Fed raising their rates and lowering their rates. What happens is when there's a surprise, when rates go up and down unexpectedly, and that happens more often. Even the smartest and most brilliant minds we have in finance can do a really bad job at making predictions as to what this happens. So this is where ultimately one of the ways that people get around this risk is they might ladder their, they might pick a bunch of bonds in a basket for you if you're a financial advisor, and they'll have different maturity dates on them. So you're not exposed to one particular interest rate deviation or one company in any shape or time. That's how they might diversify you. And so, but be careful and watch the bond markets, but know that in general, if you're doing this yourself and you're holding onto a lot of bonds, that when those bonds go up in value, when those interest rates go up in value, those bonds will do the opposite, because what it says, when interest rates go up, it means that investors expect bonds from this company to go up with them. So they might expect 5% instead of 3%. And they're going to be disappointed that this bond is only giving me 3%, and they won't want it. And if fewer people want something, the price of that bond goes down. Now, this is the stuff that this takes years years to figure out. And I don't use, this is why I always encourage you when you think about bonds to think about these things. But this is what this means. When you look at your 401k statement and you talk to your financial advisor and they're like the bond market, or you read, and I'm so honored because I have a lot of friends in the financial industry in New Mexico. They send me their quarterly reports. I'm on their email list of how they feel about how the market moves and other things. And you're going to read this. And my guess is if you have an advisor, they'll send you the same thing. They write you a little blog post about where they think the market's going to move. Some of this can be really intimidating. Some of the language used can be really tough. All financial advisors will explain it to you if they're worth their weight in anything. So, and to give you a sense of bonds, take a look. This is the safest companies are rated AAA rated companies. And to get a sense about risk as well, risk comes in different categories. We said the 3 companies. There are 4 grades of bonds that we consider investment grade in finance. These are bonds that have a very low chance of default. Now, default risk is really important because the only way you won't get paid your interest payment every year is if the company goes bankrupt. Because when you're a bondholder, you're like an unsecured debt holder. So if a company goes bankrupt, who do they have money to pay off first? They'll pay off the banks first because they're secured debt holders. They'll pay off the IRS for any back taxes that they might owe. They'll pay the person who's handling the bankruptcy themselves. And they're kind of at the bottom of the barrel, are 2 groups of people to which we belong right now most of the time. One is the bondholders who are unsecured debt holders who, if they are lucky in bankruptcy court, instead of that $1,000 payment for that $1,000 bond you expect in 10 years, maybe they'll negotiate $250 or $300 for you. And then you have stockholders, common stockholders who will get nothing. And so the risk for any company is the odds that they will go bankrupt, not tomorrow, but in 5 years or 10 years, right? And so in the same sense that we might ask ourselves when examining the question of volatility, who can tell me which seed that I sow will grow? Who can tell me which company itself might falter? And when we have speculative ratings, companies that have low ratings, they offer really impressive interest rates. You might have a bond out there that seems like a really good deal. You look up the bond markets, look up available bonds and or talk to your financial advisor, and you found something that, oh my goodness, this is paying me 10% a year. That sounds like a great deal. There's no such thing in finance as a free lunch, and that comes with higher risk. The reason that companies will charge 10% a year is because there's a risk of failure. There's a risk that something bad will happen and the company will go bankrupt. An example of this, we see this in government bonds as well. Risky countries have really risky high interest rates. So for instance, Venezuela and Ukraine have the highest bond interest rates of any 2 countries right now because of the risk that the countries themselves will go bankrupt on the market. So in finance, we call these bonds that are not investment grade high yield bonds, which sounds impressive, but high yield is also known by a more informal term, junk bonds. And I will highlight it because they have a high risk of failing. And the thing you want to avoid is that risk of failure. Now, as you find out, bond interest rates change in time. They're fixed. They're called fixed income securities because an individual bond, when they issue it, has to pay you that sum of money unless they're callable or something else happens to the company. But in general, new issues of bonds that are really, really safe have gone down in the interest rates they offered. Even a couple years ago, you could get a bond that gave you 4%. That was a really safe company. Now debt is about 2.5% per year. It is better than a savings account, but it is not a high amount of interest. And here's where we come to the challenge of investing. Any wealth manager, any investment manager, be it a really big company or a small company, is confounded by the question of how we get yield. One financial advisor that I spoke to recently said that the challenge for their clientele when they're retired was to hit a 6% return every year on average. Why 6%? Because retirees, one of the golden rules of thumb in finance is if you start with a pool of money and you're fortunate enough, let's say, to have a pool of money in place, 4% a year represents a distribution that you have to make. So 4% a year, you take off 4% off the top for you. You take off 1% for the advisor. to pay the advisor. Advisors often get paid as a percentage of the money you have invested with them. So 1% or 0.5% might be their investment cost. That other 1%, operations, charges, fund fees, anything else that falls through that, that little barrier is really hard to make. And so conservatively, a lot of very clever wealth managers are struggling very hard to hit 6% and still have a reliable portfolio. To hit a 4% withdrawal every year and keep the portfolio from not going down is an incredibly challenging thing. But there are circumstances when withdrawals can be higher. If you're looking at if you're looking at legacy and you're less interested in legacy or leaving things to family members, you might explore greater withdrawal options. Most financial advisors, conservatively, because they don't know how long you might live, and nobody really does, might argue for a more conservative 4%. But what's happened in the last 40 years is our assumptions on what we can get on these things have dropped significantly. Stocks, real estate, bonds, and cash and inflation, they've all come down. That makes it harder to generate returns. So anything from the UNM endowment, and this is public knowledge right now, UNM endowments, large funds, pensions, and other places are looking to places other than what's on this sheet to make money. One of them is private equity. Private equity refers to investments that people make or funds make into privately held companies. Now, if I buy a company like Microsoft or Oracle, I know that in buying them, it's publicly traded. And each quarter, they're required to show me their financial statements. They're required to have all of this, they disclose all of this information to the SEC. If you're a privately held company, you don't have those disclosures. At any given time, I can't tell you. There are very impressively sized privately held companies like IKEA, for instance. I can't tell you precisely what IKEA's financial position is. I don't have the ability, and no one outside of the company who's not actual owner of that privately held company have access to information about how the company's doing. So it's a little bit risky because it's a little bit more opaque for investors. Now, private equity is not a bad thing. I'm not trying to portray it as something that's negative. It's just something that we understand less than a lot of publicly traded companies. But a lot of markets are looking for those returns. Startup companies, other places to make money, other funds. Another thing to look at as well is if we think about this, and I'm going to blow this up a little bit to think about this over the long run, is on the more positive viewpoint. If we consider all the places somebody can invest money, small stocks typically do better in the long run than large stocks, meaning small companies. Government bonds do better than short-term treasury bonds called treasury bills. And then inflation this is over the incredible long term of 1926 to 2017. Inflation averaged a little bit under 3%. So taking this into context, if you have time, explore long-term investment principle. Now, but again, small stocks come with higher risk. Large stocks have a little bit less risk, but higher return than bonds. Bonds come with risk too, but that risk is less, but you have a lower return. And the least risky things you can buy are government treasuries because the government is considered, rightly or wrongly, to be default risk-free. So that's what we have. And I want you also to point something out as well. So much money goes into understanding finance, and the more you understand finance, and this is the true part, and there's a certain cynicism that comes with this. When you look at investments over the long run, sometimes you're lucky, sometimes you're not lucky. You can make good portfolio allocation decisions to protect you from downside risk. But if anybody asks what the highest performing group of investments will be in 3 years from now, the answer will be no one knows that answer. And if they have it right, it is almost certainly due to luck. And understand that even the people you speak to, they can help you lower your downside risk. Because one of the things, or one of the fundamental goals in finance, a good financial advisor does two things. One, they're able to give you the confidence to put your money someplace where you don't feel comfortable operating. They give you the confidence to say, I will help you take care of this. And so now you might be generating 6% a year on average, as opposed to 1% or 0% in a savings account. The goal of a financial advisor is typically not to beat the market. It's to give you the confidence and security to answer your questions. The second goal of a financial advisor is to protect you from downside risk. When something bad happens, like a recession, if the market goes down 10%, it goes down from 100 to 90. To get back up to 100, the market has to go up 11.1%. It is incredibly hard to make up for losses when they happen. Protecting yourself from downside risk protects your portfolio, your income stream, and everything else in the market. So when we look at these things, this is really hard to read, this investment challenge, and I don't want you to read it, but each of these things, Callan does this thing where they create this periodic table of investment returns. Things that are the same thing are the same color. And here, this is a timeline that goes from 2001 to 2020. And we could stare at this colorful chart for hours and try to find patterns. And it would be a complete waste of our time. Because when we notice these things, we can say, oh, large cap equity. Sometimes large cap equity is the worst performing company. Sometimes it's the best. Sometimes fixed income is the best. Sometimes fixed income is the worst. Worst performing portfolio in 2020 was real estate. What do you think one of the best performing portfolios was this year? Real estate in 2021. And so this is a really interesting market. And so the hard part is you look at all of these things and you have to understand that none of us know the answers, but good financial management protects us through stormy seas. A financial advisor should build a boat for you that guides you across the channel. So what are good financial investments? Diversification, number one. One thing that you hear a lot of is mutual funds. Mutual funds are professionally managed groups of investments. They pool investor money and the money managers earn a fee. Mutual funds are interesting because they basically hire someone to pick the best examples of each type of sector that they could invest in. A little bit in bonds, a little bit in growth stocks, a little bit in stocks from overseas, a little bit locally. And I'm going to add a little caveat to this. And this is sort of that other thing. We're going to add a little things about this. There's a big picture of this. Do you think mutual funds, on average, that are managed by a professional outperform funds called ETFs? And let me explain to you what ETFs are. ETFs are like, in the sense that mutual funds are a group of different investments, ETFs are a group of different things, often a group of things like stocks. But they seek to replicate their passive investments, which means a money manager doesn't decide what goes into an ETF. They decide on the architecture of the ETF. So an ETF has all these things, and ETFs are fairly new. They've only been around for about 25 years. 1995 was when SPY, the first exchange traded fund to follow the S&P 500, the overall market. Let's say you don't have enough time to research what stocks to buy or anything. You can invest in things like ETFs. ETFs, for instance, a market-based ETF will hold a representative basket of the 500 largest companies in the United States. So every time the market goes up 1%, the whole market, all those 500 companies in the S&P 500, one of our two big market indices, 500 companies, if they go up 1%, the ETF that follows them should also go up 1%. If the market goes down 1%, they will go down 1%. Fees can be really, really low. It's cheaper to have something that's passive that you just set and forget rather than hire a money manager to pick the best companies. There's about $8 trillion currently invested in ETFs across the world right now, and it's been growing every single year. Last year, more people bought ETFs than they bought into hedge funds. Hedge funds are where some of the best and brightest finance people go, and they're only open to investors that are called accredited investors. So more than $1 million of net worth or a certain income level. I think it's about $250,000 per year that you can demonstrate. And the reason that they have limitations to who can invest in them and their funds and corporations is that they take risks that make a lot of people uncomfortable. They have low reporting requirements, so they can invest in a large number of things to generate a higher return. So does this stuff work? So we have this choice, mutual funds, an active wealth manager, somebody who's actually looking at the stocks, making the best decisions. We have exchange traded funds. I want to buy something like the gold market. Oh, here's a gold ETF. It owns all the good gold companies and all the bad ones. They don't discriminate between them. They just set them and forget them. What do you think does better? Warren Buffett tested this question. Warren Buffett, a very famous investor, you may know, from Omaha. In the 1970s, they set up Berkshire Hathaway. Actually, Berkshire Hathaway was an existing Massachusetts-based textile company out of New Bedford, Massachusetts. Warren Buffett came and was trying to sell his shares of the company to the CEO. The price they agreed upon, which was at actually the Wampsutta Club in New Bedford, Massachusetts, which I've been to, the price the CEO agreed to, they shook their hands, and then Warren Buffett went home. The CEO said, I'll buy those shares at like a quarter less than what they had agreed to. That enraged Warren Buffett. So Warren Buffett did what anyone who is enraged might and bought the entire company out of spite to fire the CEO. And then took Berkshire Hathaway, located in New Bedford, Massachusetts, moved it to Omaha and turned it into a company that does everything from insurance to owning Dairy Queen. So in 2008, Warren Buffett, a very famous investor, challenged the hedge fund industry and suggested that the S&P 500 index fund, an ETF that just follows the market, would do better than hedge funds over 10 years. Hedge funds, ETFs, this ETF, by the way, a lot of S&P 500 ETFs charge no fees, 0% fees. You can buy into it and you have exposure to 500 companies. Hedge funds have financial professionals using the best math, the best data, the best software to pick the best companies. They were beaten by a general market fund over a 10-year period. The index fund went up 85%. The average hedge fund went up 22%. Hedge funds, the typical fee for a hedge fund is what we call 2 and 20. 2% of the total investment you make with them, plus 20% of profits. I have a great private question here. This is really good. I have a mental model for market investing that is time-based, which is to 1, hold a year or 2 of my projected expenses in cash. Ooh, very smart to be conservative. Number 2, and I don't need and any dollars I don't need for the next 5 or more years, I invest in equities. And number 3, in between those timeframes, I consider bonds. Does that make sense? That does make sense, and it's fair if it works for you. And I always say that this is the key question. This is actually a good launching point to where we're going to go now. I know I'm running a little bit over time, but I'm going to finish up a little bit here to get you guys a sense of this, and I will be here as for any questions you have. So when we think about these things, when we think about market performance in portfolios, this thing is very nice because the way that this person is approaching it, they're putting enough of their cash aside so that if they had an emergency, a medical emergency, something like this, they wouldn't need to dip into those funds. It can be hard if you need a lot of money up front to sell something that isn't liquid. Sell something like a bond in a bad bond market, or sell something like a stock in a bad stock market. You might take on losses you might not otherwise do. So that's why even investment managers have to maintain a pool of cash, even though it doesn't return a lot of money. It's safe, and I think that's fantastic. And then they take some money off the side that they don't need into equities and some extra into bonds. It depends on the ratio that works for you, but if you're happy with your returns and you look at it and say, this is a level of risk that I'm comfortable with, then that sounds like a great portfolio for you. Behavioral finance. One of the things that has come to light in the last 20 years is how we make investment mistakes. And believe me, we all have made them. Every single person, and that's okay. Given enough time, we'll always make mistakes. But why did we make mistakes? Did we make a sound decision because we were unlucky? Or did we make a bad decision that could have been avoided? Be honest with ourselves here. And I can tell you, there are blunders I have made. Recognizing the circumstances to these decision-making things will help reduce the effect of blunders. And I want to give you context for this, and this is really important. This builds on about 50 years of theory that's only really been taken seriously in finance for 20 years because we had a traditional classical economics bent. People only make logical decisions when they approach investments. But this is something very, very important. Let's say that one of the things in finance we call prospect theory. Imagine for a second, I passed out $20 to everybody in this room. You'd be mildly happy. And I don't know, I write down your addresses, I send you a $20 bill. great, he's bribing us to come back next session. That would be great. It would make you mildly amused, $20 you didn't have before. Now imagine on the other hand, I send you a surprise $20 bill. A surprise $20 bill. Why? This was a free talk. Why would this person take time out? Why would he send me a $20 bill for his finance presentation? You would be very annoyed. Now imagine the level of that emotional response. The joy you feel from receiving 20, the annoyance you feel from getting a surprise bill. Which do you think is bigger? The annoyance is the bigger emotional reaction. We've actually measured this in finance. Losing $1 is twice as great an emotional weight to us than gaining a surprise dollar. So what happens in those situations? How does this affect investing? It means we make decisions differently when the market is going down than when the market is going up. And a lot of those decisions aren't logical. So when stuff is going the bad way, we can make bad choices. And I want you to think about two questions I'm going to ask you. And you can participate if you want. You can put your answer in the chat window. There's no shaming here. There's nothing that I want you to worry about with this. But to kind of this last big thing. So let's say New Mexico New comes out and they give you $1,000. You have first before I want any answers. A, you can receive another $500 for sure. Oh, great. This is the best lecture I've taught. Look at all this money. B, I take out a fair coin. And you're like, Reilly, I don't trust that you have fair coins. You're a finance person. But you take out one of these things, take out a fair quarter, and I flip it. If it comes up heads, you get another $1,000. And if it comes up tails, you get nothing. Okay. Think about that question. Scenario one. Don't answer it yet. I'm gonna go through both and you can answer it. Scenario two, New Mexico New gives you $2,000. These scenarios keep getting better and better, don't they? This is nice. You have the following choice to make. Number one, you can lose $500 for sure. Okay, we send you a surprise bill. As it turns out, we don't have $2,000. You can flip a fair coin. If the coin flip comes up heads, you lose 1,000. But if it comes up tails, you lose nothing. So if you want to participate, I welcome you. You can either put it in the chat window publicly or send them to me directly. And I'll take about 30 seconds really quick. What are your answers for 1 and 2? Are they A, comma, B? Are they B, comma, A? And there's the thing, there's no answers. There's no right answers. I'm just asking what you would do personally in these situations. There's no way to do this, okay? Pretty good. Awesome. Awesome. Thank you. Good input. Got a few of these here. This is good. Good, good, good. I'll give you another 10 seconds. All right. Okay. Awesome. Great. We have a variety of answers, which I love, but they seem to be, we have a limited sample size, but they seem to follow kind of what I expected. Many people behave differently in both of these situations because we're focusing on the changes themselves rather than the changes to our wealth. And I know a lot of you were very clever and said, Reilly, all of these have an expected return of 1,500. That was actually, that's a red herring. It's not what I'm looking for. So in this example, I give you, in the first example, how did you answer? In the first example, 85% of respondents in research pick A. That is the common thing for people to do. Ooh, free money plus additional free money? That sounds good for me. I can make a plan off of that. But when things go south, things get a little haywire. In scenario 2, in research and finance about this, 70% of people actually pick B in scenario 2, which seems to approximate what people did here. Basically, the question is, not whether or not you would take a risk, but are you being consistent with the risk that you are taking? If you are a risk-averse person, if you are a person who does not enjoy taking risks, your answers for scenario 1 and 2 should be the same. I receive another 500 for sure. I accept my $500 loss for sure. If you are a person with a little bit more risk tolerance, the answers should be the same. I also didn't answer this. I answered this the way that most of you answered this when I answered this the first time. So B and B for both of these. If you like taking risk, take risk on the upside and then the downside, but don't change horses midstream because the current changed. So the problem is, if you're a risk averse person in good times, why do you suddenly become risky in bad times? If you're a risk averse, if you're risky, nobody went the other way. Nobody was really risky in good times and not risky in bad times, but that's also possible. Focus on the impact to your wealth, not gains and losses as percentages themselves. Don't start taking risks that you haven't taken before just because the market is down 15%. Because the problem is, there are people who specialize in risk and they've built up years and years of knowledge on this, and they know investors like that will make those decisions when they happen. Be consistent to yourself whenever possible, and that will help you avoid making decisions that help exacerbate your losses in a down economy. A couple other big points. Loss aversion. This is a really hard one. Sometimes we do something called anchoring. It sounds like an occupational hazard for sailors. We associate an investment with a purchase price. I will sell this stock if I get back up to $20 a share. I will sell this property if I can only get what I paid for it. Does this make sense? There's symptoms to this. We often call this get-evenitis in finance. We often beat ourselves up around this question. We often find it hard to justify why we ever bought a stock in the first place. But remember, when you buy any investment, don't focus on anything about the past related to that investment. Focus on what the future will hold. If the property is going to go up in value by a lot in the next 5 years, hold on to that thing. If you think if the stock's going to go up, hold on to it. But if it looks like the property is still going to go down in value in the next 3, 5, 10, 15 years, why not sell now? And that's the question that we have with a lot of individuals. Diversification is tricky too. You might be approaching retirement, you might be looking for retirement. We're often tempted to overinvest in a company we work for. You know the company better than other people. You might be an insider. You might know the CEO and the executive team. You think, my goodness, we're selling something that makes sense. And one question I have on this is that this can blind us in certain ways. Your earnings and retirement plans already likely depend on that company. View all of your assets as a portfolio. The cash you have, the property you have, these investments, the investments that you have, the 401k plan that you have. And then C, you don't want any individual company or any individual thing to take up too much, because sometimes we can be wrong and sometimes we can expose ourselves to bankruptcy risk. So trading is another issue that we have. Oh, really good question. One question I have, another private question, do you count Social Security in cash? This is a really good question. So Social Security is really interesting because we can look at Social Security a number of ways. We can look at it, once you figure out what your amount that you are entitled to get in Social Security on your retirement date, that becomes income. And then that income that you use from Social Security, what are you doing with that income? Is it paying expenses or going into different investments? Or going into different things? And only you know the answer to this. You and your financial advisor know the answer to this particular question. So it is the nature of what you do with the Social Security money that decides where it fits. It could be cash, but it also could be potential investments towards property, potential investments towards investing, other things. So too much trading. When people start trading stocks, and it's so easy now, there are all these apps out there, you can put it on your phone and people buy and sell it. You can become overconfident really quickly. And that's always the thing. I have never had this benefit of being overconfident, but I'm so glad that some people have. But anyway, the problem is that when you trade too much, when you talk about day traders and you feel like, oh, I don't have the time to invest in this, I can look at my portfolio 4 times a year. You're doing something that's better. You will do better by buying and holding for the long run than you will by investing in an individual stock every single day and trading it over again. We actually measured this. The traders that traded the most underperformed the people who just bought and hold for the long run. Don't feel you have to do more than you have to. That's perfectly fine. Other thing as well, do men trade more than women? As it turns out, yes, men are more confident in the area of trading and investing. Do they trade more? Yes. And Reilly, if that's true, do they underperform women in investment? Yes, we've studied this 3 or 4 times. And men actually underperformed women by about 1%. per year. That's about 0.94%. Single men, it was even worse, 1.44% less than single women. You'll be tempted to trade more than you have to. If your instinct is to buy and leave it, you're going to be just fine. Don't feel like you have to do more than you have to. There's something important here, and this is the last slide that I'm going to go over that's new stuff. Avoid temptations and illogical things. Gambler's fallacy says one thing: if something hasn't happened in a while, it must be due to happen. That has not been proven to be true, generally speaking. Do not fall into gambler's fallacy, which says that if something hasn't happened in the long run, I'm at a roulette table and it's hit black 10 times in a row, I'm going to put all my retirement savings on red. That's not a logical decision. That's gambler's fallacy. And opposite of this is the hot hand fallacy, which you should also watch out for, which is that if something's done well, it will continue to do well. That's also false. Look at each thing individually. Now, big picture questions tying it all together. With your financial advisor, create a portfolio of diverse assets, which means that if any one thing goes down or a couple things go down, you are not crippled in the financial markets. Often as you get older, as you approach long-term care, put more of your assets into safe investments, bond, cash, and other investments. One question that we had dealt with long-term care and investments that we asked you all about how you felt about this. One reason I would encourage you to not deplete all of your financial resources during retirement and avoid taking or withdrawing too much from your 401k is to plan on things like long-term care. And I know no one wants, we don't know what will happen in 10, 15, 20, 30 years from now. Nobody wants to imagine that future where they have to live in a retirement home or something else where they need long-term care and other people. They can be prohibitively expensive, as you are well aware. If you have assets in place, your outcome and the freedom that you'll feel you'll have and the quality of life that you'll have will be so much better. And so focus on those things. Not because I think it'll happen, but because we all have to prepare for the potential likelihood that it could happen. And talk about, with your portfolio advisor, rebalancing your portfolios. And I want to point this out as a distinguished difference. And I read a whole bunch of literature that we've been talking about in finance about this question. There is nothing wrong with taking on more risk than your parents would have when they were retired, or somebody else that you know if you retired, if you're okay with that risk. If you've got a plan for the long run and you're looking at your portfolio and you're looking at this and saying, my goodness, I have more stocks in my portfolio, more risky things than other people my age. The question is, does it make sense to you? And does it make sense if stuff goes bad? Every quarter, about 4 times a year, always evaluate how good your performance has been. What are your goals? They change with time. Your goals when you're 55 are different than when they're 65 and will likely be different than when you're 80. Time horizon in financial circumstances change continuously. Adjust, adjust, adjust. The longer you expect to remain retired, the more risk you might have to withstand, the more market cycles. Between this, we have a big market recession almost every 10 years. Think about this, 30 years from now, 30 years of retirement, you retire at 60. We know that there's a 50% chance that either you or your partner will live to be 90. That's 3 economic cycles that you will endure where there will be recessions. Your portfolio will be different than previous generations because you understand these things, but don't let that intimidate you. And the last thing here, for those brave few who have held on to the very end, I want to show you quickly a spreadsheet that you all will receive. I built this to be roughly consistent with where I was last week, but let me switch it over here so you can see it. And then, of course, I'm not going to abandon anyone. I cleared off my schedule. Whoop, that's the wrong one again. My apologies. Let me open up the right one. There we go. There's our worksheet here, and I'll show you how to work this. This requires Excel, but if you have one of the free apps that they have, this allows you can figure it out as well. Most of you have great Excel literacy. I know some of you may not have had to use it before, and that's perfectly fine too. The first thing I want to present to you is what I call, oh, good. I know you got good news. You received the spreadsheet this morning. So if you want to open it up, you can. And if not, you can ask me any questions about it next week as well, or through email. So I have 3 sheets here. The first one's called Investment Calculator. And basically, this gives you an approximation. If you put a certain amount aside every month, how much will that grow if I have a certain return? And so as an example, let's say you're 55 years old. And let's say you expect to retire when you're 67. And let's say that you can put, I don't know, $350 a month towards some type of investment. Now, what I put here was what we call an expected rate of return. 7% is not going to be the return that you get, the return that anyone necessarily will get. 7% is an approximation, and that seems like a high number, doesn't it? Maybe you're a little bit risk averse. Maybe you should look for something a bit smaller. Maybe it's 5% as an expected rate of return. If you do this for the next 12 years, you'll physically have contributed $50,000. But because of that 5% return, that will grow to about $68,000. What does $68,000 when you're 67 mean? If you plan on being retired, this is where it gets dark. This is where it gets dark. If your retirement plan is to be retired for 20 years, before going back to work, of course, retired for 20 years, and you put your portfolio in something that earns, say, a little bit safer risk than the other one. So maybe I'm only getting 4% because it's safer. That will give me about $5,000 of income every year. And then down here, because I'm very keen on interest rates and because I'm still a nerd at heart, I've done a sensitivity analysis for you here that will calculate automatically. Let's say you're wrong about that 5% return. Let's say that return in the next 12 years, we have a 0% return. You'd only have $50,000. Let's say something terrible happens and we have an extended recession for 10 years and we lose 5% every year, you'd have $37,000. But on the other hand, let's say your investments do better than you expect. They earn 11% because they're 100% stocks and we just hit the long-term average, something that's never happened before. You'd have $100,000. And these are taken from averages in this. Err on the side of low, be aware of the downside risk. Next question is target calculator. So maybe instead of asking you the question of how much will I have if I start at 0, I have also some people in the audience who are asking and saying, okay, how much can I have, how much do I need to get to live off of, to live a comfortable retirement, for instance? And let's say right now, and this is how we're going to fill this one out. And I can zoom in for the cheap seats here, the bleachers. Let's say we're still retiring at 67. And let's say you want let's say we want $50,000 of retirement income before taxes. And you plan on being retired for 20 years and you expect a 5% annual return. To get $50,000 of income, you'll need $600,000 when you're 67 years old, $623,000 when you're 67 years old. So the stuff in yellow, it will calculate automatically. If your current age is, let's say your current age is 52. And I have a spot here for the amount you've currently saved. Maybe it's 0, maybe it's 100,000, maybe it's 200,000. Oh my goodness, thank you so much, Kristen. I appreciate it for you coming in today. Let's say you have 200,000 already in a 401k and another plan in something else. That means you have to put aside between, in the next 15 years, $750 a month to achieve that goal. So that's what it does. It brings it down. You can even see if you're really into doing this math. I have a little, all the calculations are visible. You can edit them and screw around with them. And I'm happy if you do. And then the last one is the most advanced one. And this is really interesting because this goes back to, I'm going to spend 2 minutes talking about this because this is so important. Did you know that something invented in New Mexico has become a cornerstone of financial investment worldwide? And that is something called the Monte Carlo simulator. Back in the 40s and 50s, and some of you might know this trivia fact, make sure you bring this up at your next gathering with your friends, and it'll be good. You'll seem like an expert. In the 40s and 50s at Los Alamos National Labs, we had some outstanding scientists, Stanislav Ulam and John von Neumann were two scientists that were working on very, very complex mathematical equations to figure out how stuff that's going to happen in the future will end up happening. And they went back and they found a very simple and elegant solution to predicting things that we might have a distribution of returns for, like the market, or the distribution of how electrons or something else exist in a in some kind of ether. And I don't know, I'm not nuclear. My grandfather, I have a grandfather who's a nuclear physicist. I'm not a nuclear physicist, but one of the so I apologize if you are. I messed that one up. But the Monte Carlo simulator takes a distribution of the past as a universe of potential market outcomes and puts it into a hat. And it picks out a number each year to estimate that market return. So if we say that we know that the market follows a normal distribution, looks like a hat, kind of like a bell, and it'll take parts of that distribution randomly, pick it out of there and say that will be next year's return. And so what it's useful is, because we know in finance, we can't predict what the market will do in 5 years or 10 years. Even in the next year, I guarantee you, I could ask a whole bunch of other CFAs. I'm on the board of the CFA Society of New Mexico. We could have a poll and we'd have we could all be wrong. We could have a vast distribution of where we thought the market would move in the next year. Let's try this out. Let's see if this works. So if we start today at the age of 50 and we want to retire in 17 years when we're 67, and we're starting with $50,000. In each month, we make a $500 investment. You can change all those numbers. And I put 50% of the money that I save in stocks, and I put 50% of it in bonds. Now, I know that the average return in equities is about 10%. And I know that there's a standard deviation, about 18% if it follows a normal curve, which is a lot. I know that bonds have a lower return, but they're safer. They have a lower standard deviation. I know that real estate has a certain return and a standard deviation with it. And you can screw around with these numbers too if you think these are unreasonable. These are driven from other financial averages. They're kind of industry standard levels, but they change with time. What I can do is I can simulate, and I'll show you what I mean. So what the Monte Carlo method does is it takes a number out of the hat and says, next year, the market will return 20.87%. And then it takes another number out of the hat. When you're 52 and 2 years from now, the market will go negative 6.85%. And then it will go up 10%. And you're saying to yourself, Reilly, none of these answers will be right. Of course not. But that's why we run them over and over again. And over here, I've built in a simulation that runs this 10,000 times. So if your computers break at this point, I am so very sorry. Normally we would do this with something called a macro, which is something I would build in, but I wanted you to see it in Excel so you could feel it. And what this does is every time I hit F9, it will rerun all of these simulations. And then it gives me different likelihoods of a retirement value occurring. So my median 50% value, I'd have a $315,000 portfolio. If I had a bunch of bad years in the market, I might only have 218,000. 10% of the time, 90% of the time I do better, but if I'm in the bottom 10%, 219 is all I got. But if I did better than expected, I'd have 451. And notice that even though each of these numbers change, every time I hit F9 on my keyboard, like it goes to negative 13%, anything else, because I'm running this 10,000 times, these numbers themselves don't change a heck of a lot. So really cool. So this is something for you to play with because your financial advisor has their own version of this, almost certainly, that helps you show how outcomes can change. And this is to help you prepare for the risk return scenario. And thank you so much. I had a private message thanking me. The recording will be available, and I encourage you to watch it as well on New Mexico News website. And that's what I've got. So I'm open for questions. I've run terribly over time because investments are terribly exciting. I promise you next week will be briefer, and I'm so very sorry to go over time. But thank you for those who stuck around.